billions of dollars vanished overnight, leaving a trail of devastation across global economies. Michael Burry, a sharp physician turned financial analyst, saw this catastrophe approaching years earlier. His journey began with Scion Capital, a small focused hedge fund from 2000. Burry, an outlier, possessed unique ability to sift through data identifying obscure critical market inefficiencies. He often spent 15 hours a day poring over intricate financial documents, annual reports, prospectus statements. His early successes built on finding undervalued stocks, a strategy many dismissed as slow or complex. By 2005, he shifted his intense scrutiny toward the American housing market, a sector many experts deemed robust. He uncovered a systematic failure, a profound weakness hidden beneath complex financial engineering layers. He realized countless subprime mortgages were issued to borrowers with questionable credit scores, often no income, no job or assets. These loans, totaling hundreds of billions of dollars, were packaged into Wall Street mortgage-backed securities, or MBS. MBS bundles were further sliced into collateralized debt obligations, or CDOs, creating illusion of diversified risk. Burry's forensic analysis revealed the underlying assets, those individual mortgages, were toxic time bombs. He calculated a significant percentage, perhaps 25% or even 30% of these loans were destined to default within a few years. This insight was radical, widely rejected by virtually everyone, including his own investors. He began taking massive short positions against the housing market, using credit default swaps, CDS, a relatively new financial instrument. He bought CDS contracts, effectively betting against the stability of the housing market. This involved committing hundreds of millions of dollars of his firm's capital, a daring move for a fund with assets around $600 million at that time. He faced immense pressure from investors, many demanding their money back, some questioning his sanity. For over 1,000 days, he battled skepticism and disbelief, holding on to his conviction. Experts at major financial institutions dismissed his warnings, believing the housing market was too big to fail. They pointed to years of steady appreciation and perceived lack of systemic risk. Yet Burry persisted, meticulously tracking default rates, comparing them to official optimistic projections. He saw a growing disparity between what the market believed and what data truly indicated. The sheer volume of fraudulent loans and relaxed lending standards was staggering, affecting millions of homeowners. When the housing market finally began its dramatic collapse in 2007 and 2008, his predictions proved chillingly accurate. His firm, Scion Capital, made massive profits for its remaining investors, turning modest initial investment into a fortune. Some reports suggested returns well over 800% for certain portfolios. This singular focus, this unwavering conviction in the face of overwhelming opposition, cemented Burry's legacy as a true contrarian, a visionary investor. His story reminds us of dangers of unchecked financial innovation and the importance of independent critical thought. He proved one person can see unseen weaknesses in an entire system, even when surrounded by powerful institutions clinging to false narratives. The eventual losses for the global economy ran into many trillions of dollars, affecting millions of people worldwide. One lone investor braced for an $80 trillion earthquake. Michael Burry stood alone against a wave of global disbelief. For well over 1,000 days, he battled immense pressure, a solitary figure in the financial maelstrom. His fund, Scion Capital, had committed hundreds of millions of dollars, a staggering sum nearing $600 million of its total assets, to a bet against the very foundation of the American economy. He used credit default swaps, effectively insurance policies against mortgage defaults. These instruments were largely dismissed by major Wall Street firms who believed the housing market was too robust to falter. They saw only endless growth and 2% annual appreciation, while Burry saw a catastrophic 25 to 30% of subprime mortgages destined to fail. This radical view led to calls for his removal, even demands for funds back from his own investors, who threatened lawsuits and questioned his sanity daily. His painstaking research into millions of individual loan documents revealed the widespread rot beneath complex mortgage-backed securities and collateralized debt obligations. Each day brought fresh skepticism, but Burry meticulously tracked default rates, seeing them climb steadily from a mere 4% to 7%, and then 12%, a relentless march toward his dire predictions. He witnessed firsthand the lax lending standards that had fueled a credit bubble, creating millions of risky loans. These loans were packaged into financial products sold globally, perpetuating an illusion of safety. When the housing market finally began to crack in 2007, the cracks quickly became chasms. Default rates soared past 15%, then 20%, validating his isolated calculations. The subprime crisis cascaded into a global financial meltdown in 2008. Burry's firm delivered extraordinary returns over 800%, for its remaining investors a monumental vindication. While Scion Capital saw massive profits, millions of families lost their homes, their savings, their futures. The global economy suffered losses into many trillions of dollars, far beyond market corrections. This catastrophe exposed the profound dangers of unchecked financial innovation and the catastrophic consequences of ignoring inconvenient data. Burry's persistence showed that one individual with unwavering conviction and forensic analysis could foresee a disaster that institutions with thousands of employees and endless resources completely missed. His story is a stark reminder of the importance of independent thought and skepticism, even when facing the combined might of an entire industry clinging to a false narrative. Systemic failures allowed countless fraudulent loans to proliferate, affecting every corner of society. Billions vanished while Wall Street celebrated. Michael Burry, however, knew the financial system remained fundamentally broken. After his fund, Scion Capital, delivered over 800% returns, a monumental vindication of his dire warnings. Many believed reforms would immediately follow. Instead, the very structures that facilitated millions of risky subprime loans remained largely intact. Regulators faced intense lobbying from firms that lost billions of dollars but still held immense political power. The catastrophic 25 to 30% default rate predicted by Burry across subprime mortgages was just the beginning of understanding systemic rot. The entire world was reeling from trillions of dollars in losses far beyond any single market correction ever seen. Approximately 8 million Americans lost their homes in the 2008 crisis, a staggering human cost often overlooked amidst the financial figures. Millions more lost their jobs, savings, and retirement security. The gross domestic product of many nations contracted by several percentage points, pushing economies into severe recessions. Despite these widespread impacts, the architects of the mortgage-backed securities and collateralized debt obligations that amplified the crisis largely escaped accountability. Only one single criminal conviction of a top executive related to the crisis occurred in the United States, a stark contrast to the widespread fraud identified and ignored. Burry himself observed a profound reluctance to acknowledge the true depth of the deception. His analysis suggested that the fundamental moral hazard where institutions could take enormous risks, knowing they would be bailed out by taxpayers, persisted. Many economists and political leaders downplayed the role of Wall Street's reckless behavior, blaming a housing bubble instead of the intentional design of toxic financial products. The financial sector rebounded relatively quickly within a few years, while ordinary citizens struggled for a decade to recover lost wealth and opportunities. Over $600 billion in toxic assets were eventually purchased by government entities. To stabilize banks, a massive transfer of risk from private hands to the public purse. This left taxpayers bearing the burden of an industry's failures. The crisis fundamentally reshaped how individuals viewed financial markets, eroding trust in institutions that were supposed to safeguard their investments. Burry's persistent contrarian view extended beyond merely profiting from the collapse. It was about exposing an intrinsic flaw in capitalism itself, where short-term gains superseded long-term stability and ethical conduct. He foresaw subsequent bubbles in other sectors, arguing that the lessons of 2008 were not truly learned. His continued warnings often fell on deaf ears, just as his initial predictions did, highlighting a cyclical pattern of denial and eventual crisis. The market became increasingly efficient at masking risk rather than eliminating it, a dangerous evolution.